Stop. If you're holding even a single ounce of silver or gold right now, you need to hear this urgent warning before the markets open Monday morning. Legendary trader Francis Hunt, the man who's called every major precious metals move over the last decade, just issued a red alert that could make or break your entire portfolio. We're talking about a seismic shift happening in the silver market right now that most investors are completely blind to. Here's what's got. Francis shook. The gold to silver ratio is flashing signals we haven't seen since 2008. Institutional money is quietly flooding into one metal while abandoning the other, and there's a critical price level that is about to determine whether silver explodes to 50 plus or crashes back down to the 20s. And if you're on the wrong side of this move, you could watch years of gains evaporate in weeks. But here's the controversial part. Francis reveals why the metal everyone's talking about might not be the play, and why the safe bet could actually be your biggest risk right now. This isn't theory. This is decades of trading experience distilled into one urgent message you cannot afford to miss. If you want to protect your wealth and position yourself for what's coming, smash that like button right now, and let's dive into Francis Hunt's shocking silver price alert. All right, welcome back to the channel, and if you're new here, you've just walked into what might be the most important conversation about precious metals you'll hear all year. I'm not exaggerating when I say that what we are about to discuss could fundamentally change how you think about your gold and silver holdings, and more importantly, what you do with them in the coming weeks and months. Francis Hunt, for those who don't know, isn't just another talking head throwing opinions around on the internet. This is a man who has spent over 3 decades in the financial markets trading everything from currencies to commodities. And he's built a reputation on making calls that most people thought were crazy until they turned out to be absolutely right. And right now, he's sounding an alarm that we simply cannot ignore. Let me set the stage for you because context matters tremendously here. We're living through one of the most unusual economic periods in modern history. Central banks around the world have printed more money in the last few years than in the entire previous decade combined. Inflation, despite what official numbers might tell you, is eating away at purchasing power in ways that everyday people feel every single time they go to the grocery store or fill up their gas tank. And in times like these, precious metals have historically been the refuge, the safe haven, the place where smart money goes to preserve wealth when everything else seems uncertain. But here's where things get interesting, and this is where Francis Hunt's analysis becomes absolutely critical. Gold has been performing relatively well, hovering near all-time highs, getting plenty of mainstream attention, and generally doing what gold does during uncertain times. Silver, on the other hand, has been behaving in a way that has many traders scratching their heads. It's shown moments of explosive strength, shooting up dramatically, only to pull back and consolidate in patterns that suggest something much bigger is brewing beneath the surface. And this is where the story gets fascinating, because Francis Hunt has identified something in the technical patterns, the fundamental supply and demand dynamics, and the broader macroeconomic picture that suggests we're approaching a critical inflection point. The decisions you make in the next few weeks about your precious metals holdings could determine whether you are positioned for substantial gains or whether you're left holding positions that underperform dramatically. Now, let me talk about the gold to silver ratio because this is one of the most important metrics that serious precious metals investors track. And yet, it's something that casual investors often completely overlook. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged somewhere between 50 and 60 to 1 over long periods of time. But we've seen this ratio swing wildly, and those swings have corresponded with some of the most dramatic moves in precious metals markets. When the ratio gets extremely high, meaning gold is very expensive relative to silver, it has historically been a signal that silver is undervalued and due for a catch-up move. When the ratio gets very low, it suggests silver might be overvalued relative to gold. Right now, according to Francis Hunt's analysis, we're at a level in this ratio that has historically preceded major moves one way or another. What makes this particularly interesting is that we're not just looking at the ratio in isolation. Francis has overlaid this with technical analysis of both metals, looking at trend lines, support and resistance levels, moving averages, and momentum indicators. And what he's seeing is a convergence of signals that suggest both metals are approaching decision points, but silver in particular is coiled like a spring. Think about it this way. Silver has industrial applications that gold simply does not have to the same degree. Silver is used in solar panels, in electronics and medical applications, and in a growing number of green energy technologies. As the world transitions toward renewable energy and electric vehicles, the industrial demand for silver is potentially explosive. At the same time, silver maintains its monetary metal status, its safe haven appeal, and its role as a store of value that has persisted for thousands of years. So you've got this unique situation where silver sits at the intersection of industrial commodity and monetary metal, and that creates dynamics that can lead to price moves that are far more dramatic than what we see in gold. Gold is largely a monetary metal and a store of value. Its industrial uses are relatively limited. Silver, on the other hand, is being pulled in multiple directions by different forces, and when those forces align, the moves can be breathtaking. Francis Hunt has been tracking these forces meticulously, and what he's seeing right now is a setup that reminds him of previous moments in market history when silver made explosive moves that caught most investors completely off guard. Let me take you back to some historical context, because if you understand what happened in previous silver bull markets, you'll understand why Francis is so focused on what's happening right now. In the late 1970s, silver went from around $4 an ounce to $50 an ounce in a matter of months. Now, that was an unusual situation involving the Hunt brothers trying to corner the market, but it demonstrated just how explosive silver could be when supply and demand dynamics got out of balance. More recently, in 2011, silver went from around $18 to nearly $50 in just a few months. That move was driven by a combination of factors including quantitative easing, concerns about currency devaluation, and a flood of investment demand into precious metals. People who were positioned correctly in silver during that move saw returns that dwarfed what gold delivered during the same period. But here's the flip side, and this is where Francis Hunt's warning becomes crucial. Silver is also more volatile than gold on the downside. When precious metal sentiment turns negative, silver can fall harder and faster than gold. This is because of that industrial component. If there are concerns about economic slowdown or recession, industrial demand for silver can weaken, and that puts downward pressure on prices, even while the monetary aspects might still be supportive. So silver is a double-edged sword. It offers the potential for outsized gains compared to gold, but it also comes with increased risk and volatility. The question then becomes, where are we in the cycle right now, and which way is silver likely to break from here? Francis Hunt's analysis suggests that we're approaching a major technical level in silver that will determine the trajectory for months, or potentially years to come. There's a specific price point that silver has tested multiple times, and each time it has either broken through and rallied significantly or failed at that level and pulled back. We're approaching that level again right now, and the technical setup, combined with the fundamental backdrop, suggests that this next test could be the one that determines whether we're entering a major silver bull market, or whether we're going to see another disappointing pullback that frustrates silver investors once again. And this is where your positioning matters tremendously. If you're heavily weighted toward gold and have little or no silver exposure, Francis suggests you might be missing the asset that has the potential to dramatically outperform. But if you're overweighted in silver without understanding the risks and without a plan for what to do if the technical level fails to hold, you could be setting yourself up for significant disappointment. The key is understanding the setup, recognizing the critical levels, and having a plan for how to respond based on what the market actually does, rather than what you hope it will do. This is where amateur investors get themselves into trouble. They buy based on hope and excitement, rather than based on a clear understanding of the technical and fundamental picture. Now let's talk about what's happening in the physical silver market, because this is another piece of the puzzle that Francis Hunt has been monitoring closely. There have been persistent reports of tightness in the physical silver market, with premiums over spot prices remaining elevated, delays in delivery for large orders, and generally signs that physical demand is robust, even while paper prices have been relatively contained. This creates an interesting dynamic because the price we see quoted for silver is largely determined by paper trading in futures markets and through various financial instruments. But if physical demand is strong and supply is tight, there can be a disconnect between the paper price and what's actually happening in the real world of physical metal. This matters because if that disconnect becomes too large, it can eventually lead to a snapback where the paper price has to adjust to reflect physical reality. We saw hints of this dynamic during the Wall Street bet silver squeeze attempt a few years ago, where retail investors tried to drive up silver prices by buying physical metal and taking delivery. While that particular effort didn't result in a sustained price increase, it did highlight the potential for physical demand to impact prices when it's concentrated and sustained. Francis Hunt believes that institutional investors and central banks are quietly accumulating physical precious metals, and if that's true, it would represent demand that's more sustained and significant than retail buying spikes. Central banks have been net buyers of gold for years now, diversifying away from dollar-denominated assets and building their gold reserves. The question is whether they're also accumulating silver, and whether sovereign wealth funds and large institutional players are starting to view silver as an essential component of a diversified portfolio in an era of currency uncertainty. If that shift is happening, it would represent a fundamental change in demand dynamics that could support much higher prices over time. But these are the kinds of shifts that happen slowly and then suddenly. For a long time, nothing seems to change, and then seemingly overnight, prices move dramatically as the market reprices to reflect new realities. Francis Hunt is also watching the US dollar very carefully because the dollar's trajectory has enormous implications for precious metals prices. Precious metals are priced in dollars, so when the dollar strengthens, it typically puts downward pressure on gold and silver prices. And when the dollar weakens, it typically supports higher precious metals prices. Right now, the dollar is at a critical juncture. We have seen it rally significantly over the past couple of years as the Federal Reserve raised interest rates aggressively to combat inflation. But there are signs that the dollar might be topping out, and if we see a sustained decline in the dollar, it could be rocket fuel for precious metals. The challenge is that currencies don't move in straight lines, and the interplay between interest rates, inflation expectations, economic growth, and geopolitical factors creates a complex web of forces that can push the dollar in different directions over different timeframes. Francis Hunt's technical analysis of the dollar suggests that we're near important levels that could determine whether the dollar continues higher, consolidates, or begins a significant decline. And precious metals, investors need to be watching this closely because a major move in the dollar will almost certainly be accompanied by a major move in gold and silver, just in the opposite direction. Let me also address something that Francis Hunt has been emphasizing, which is the importance of not being dogmatic or married to a particular view. One of the biggest mistakes investors make is deciding that they're bullish on silver or gold, and then ignoring evidence that contradicts that view. The market doesn't care about your opinions or your positions. The market will do what it does, based on the collective actions of millions of participants. And your job as an investor is to read what the market is telling you and respond accordingly. Francis Hunt has been bullish on silver at various points in his career, and he's been bearish at other points. What matters is adapting to current conditions rather than stubbornly holding onto a view that isn't working. Right now, his analysis suggests that we're at a pivotal moment, but he's also clear that there are scenarios where silver disappoints and scenarios where it exceeds even optimistic expectations. The key is having a framework for understanding which scenario is playing out as events unfold. This means watching specific price levels, monitoring volume and momentum indicators, paying attention to how silver behaves relative to gold, and staying aware of broader macroeconomic and geopolitical developments that could impact precious metals. It's a dynamic process that requires active engagement rather than passive hoping. One of the things that Francis emphasizes is the importance of understanding market structure. By market structure, I mean who's positioned on which side of the market, where the large players are positioned, and what would cause them to have to adjust those positions. For example, if there are large short positions in silver held by commercial banks or other institutional players, and the price starts to rise above certain levels, those shorts might be forced to cover, meaning they'd have to buy silver to close out their positions. This can create what's called a short squeeze, where buying begets more buying, and prices can rise very rapidly as shorts scramble to cover. Conversely, if there's a large amount of speculative long positions in silver and the price starts to fall, those longs might sell to cut losses, and that selling can feed on itself and create sharp downward moves. Understanding positioning helps you anticipate potential moves and understand why markets sometimes move in ways that seem disconnected from fundamentals. The Commitment of Traders report, which is published weekly by the CFTC, provides insights into positioning in futures markets, and it's something that serious precious metals traders watch closely. Francis Hunt incorporates this information into his analysis because it provides clues about potential market dynamics that might not be obvious from just looking at price charts. Another factor that Francis has highlighted is the energy markets and their relationship to precious metals. Energy prices, particularly oil prices, have major implications for inflation, for economic activity, and for the profitability of mining operations. Silver mining, like all mining, is energy intensive. When energy prices are high, it increases the cost of production for silver, which can put a floor under prices because miners won't produce at prices below their cost of production. At the same time, high energy prices contribute to broader inflation, which tends to be supportive of precious metals prices as inflation hedges. Right now, energy markets are in their own state of uncertainty, with geopolitical tensions, OPEC production decisions, and the transition to renewable energy all creating cross-currents that make oil prices difficult to predict. Francis Hunt sees the interplay between energy markets and precious metals as an important factor to monitor. If energy prices spike due to supply disruptions or geopolitical events, it could accelerate inflation concerns and drive investors toward precious metals. If energy prices fall due to weakening demand or increased supply, it could ease inflation pressures, but might also signal economic weakness, which would be a mixed signal for precious metals. These interconnections between different markets are part of what makes macroeconomic analysis so challenging and why having someone like Francis Hunt, who can synthesize information from multiple markets, is so valuable. Let's also talk about mining stocks, because this is an area where Francis Hunt has particular expertise. Mining stocks are leveraged plays on the underlying metals. When gold or silver prices rise, mining company profits can rise even more dramatically because their costs are relatively fixed, while their revenue increases with metal prices. This can lead to outsized gains in mining stocks during bull markets in the metals. However, mining stocks also come with company-specific risks, including management quality, geological challenges, political risks in the countries where they operate, and financing risks. Francis has seen many cycles in mining stocks, and he's witnessed how they can dramatically outperform during the right conditions, but can also be devastating investments during bear markets. Right now, his analysis suggests that mining stocks are potentially setting up for a significant move, but the direction will depend heavily on what happens with the underlying metal prices. If silver breaks out to the upside and begins a sustained bull market, silver mining stocks could deliver returns that are multiples of what the metal itself delivers. But if silver fails at current resistance levels and declines, mining stocks could fall even harder. This leverage cuts both ways, and it's why position sizing and risk management are so critical when investing in mining stocks. You want enough exposure to benefit if the move goes in your favor, but not so much that a move against you causes serious financial damage. Francis Hunt also brings up something that many investors don't think about, which is the tax treatment of physical metals versus mining stocks versus precious metals ETFs. Depending on where you live and your specific tax situation, the tax implications of gains in these different vehicles can vary significantly. Physical gold and silver are often treated as collectibles for tax purposes in the United States, which can mean higher capital gains tax rates than you'd pay on stocks. Mining stocks are taxed like regular stocks, with different rates for short-term versus long-term capital gains. ETFs can have their own tax quirks depending on their structure. None of this should be the primary driver of your investment decisions, but it's a factor worth considering. And it's the kind of detail that separates sophisticated investors from those who only think about the upside without considering the full picture. Now, I want to address something that Francis Hunt is particularly concerned about, which is the potential for government intervention in precious metals markets. Throughout history, governments have intervened in gold and silver markets when they felt those markets posed a threat to their currency or their economic policies. The most famous example is probably Executive Order 6102 in the United States in 1933, which required citizens to turn in their gold to the government at a set price. While a repeat of that exact scenario seems unlikely in today's world, there are other forms of intervention that could impact precious metals investors. These might include changes in tax treatment, restrictions on imports or exports of physical metal, changes in regulations around ETFs or futures markets, or even changes in reporting requirements for holdings. Francis isn't predicting that any of these things will definitely happen, but he thinks investors should be aware that they're possible, particularly if precious metals prices rise dramatically and are seen as a referendum on government currency policies. This is part of why he emphasizes diversification, not just across different metals, but across different forms of holding them. Having some physical metal that you possess directly, some exposure through ETFs that provide liquidity and ease of trading, and perhaps some mining stocks that give you leverage and dividend income creates a more resilient portfolio than putting everything into one form of precious metals exposure. Let me now tie all of this together into what Francis Hunt sees as the critical decision point we're facing right now. Based on his technical analysis, his reading of market positioning, his assessment of fundamental supply and demand dynamics, and his macro view of currencies, interest rates, and inflation, Francis believes that silver is at a make-or-break point. There's a specific price level which varies slightly depending on which contract or time frame you're looking at, but broadly speaking, it's in a range that silver has tested multiple times. Above that level, there's relatively little resistance until you get to much higher prices, which means that a breakout could lead to a rapid and sustained move higher. Below that level, there's support, but if that support fails, silver could decline back to levels that would be very disappointing for anyone who's bought recently expecting an imminent rally. Gold is in a similar situation, but with some important differences. Gold has been stronger relative to silver recently, which has pushed the gold to silver ratio higher. If silver starts to outperform gold, we'd see that ratio decline, which historically has happened during strong precious metals bull markets. Silver tends to lag gold early in bull markets and then play catch-up aggressively later in the cycle. If Francis is right that we're approaching that catch-up phase, then silver could dramatically outperform gold over the next year or two. But if the precious metals bull market thesis is wrong, or if it gets delayed, then silver's additional volatility and industrial sensitivity could make it underperform gold on the downside. This is why Francis Hunt's message isn't simply buy silver or sell silver. It's more nuanced than that. He He's saying watch these levels, understand what a break above or below them means, and position yourself accordingly. If you're bullish on precious metals overall, consider having exposure to both gold and silver with your allocation between them based on your risk tolerance and your time horizon. If you're more conservative, lean toward gold. If you're willing to take on more volatility for the potential of higher returns, lean toward silver. If you're somewhere in between, have meaningful exposure to both and rebalance as conditions change. He's also emphasizing that timing matters. Buying silver after it has already rallied 50% and is making new highs is very different from buying it when it's consolidating near resistance or support levels. The best risk-reward setups typically come when you are buying near support with a clear stop-loss level below you, so you know your risk, and with clear resistance levels above you, so you know your upside targets. Chasing momentum can work sometimes, but it's also how investors end up buying tops and suffering through painful drawdowns. Francis Hunt has built his reputation on taking positions that are unpopular at the time, but that makes sense based on his analysis, and then having the patience and discipline to hold those positions until they work, or until his analysis proves wrong and he exits. This requires a level of emotional control that most investors struggle with. It's human nature to want to buy when everyone's excited and prices are rising, and to want to sell when everyone's fearful and prices are falling. But that's usually exactly the wrong thing to do. The best opportunities come when you're willing to act contrary to the prevailing sentiment, but you have to have a solid analytical foundation for doing so. You can't just be contrarian for its own sake. As we move forward from here, Francis suggests watching several key indicators beyond just the price of silver itself. Watch the dollar and whether it breaks down from its recent strength. Watch real interest rates, meaning interest rates adjusted for inflation, because when real rates are negative or very low, it's supportive of precious metals. And when real rates are high, it's headwind for precious metals. Watch the gold-silver ratio and whether it starts to decline meaningfully. Watch physical premiums and whether they expand, suggesting tightness in physical supply. Watch mining stocks and whether they start to outperform the metals, which often happens early in new bull markets as investors anticipate higher metal prices flowing through to mining company earnings. All of these data points together paint a picture of where we are in the cycle and whether conditions are aligning for a major move. Francis Hunt has the experience to synthesize all of this information and distill it into actionable insights, and that's why his current warning is so important. He's not someone who cries wolf or who's constantly predicting crashes or rallies. He's measured and thoughtful in his analysis, which makes it all the more significant when he says that we're at a critical juncture that demands attention. So where does this leave you as an investor? First, take an honest inventory of your current precious metals exposure. Do you own any gold or silver? If so, how much relative to your overall portfolio? Is it in physical form, ETFs, mining stocks, or some combination? Do you have a plan for what you'll do if prices rise significantly or fall significantly? Or are you just hoping it works out? If you don't have exposure to precious metals, is that because of a deliberate decision based on your analysis? Or is it simply because you haven't thought about it? Francis Hunt's analysis suggests that this is not a time to be complacent or to operate on autopilot. This is a time to be actively engaged and thoughtful about your positioning. Second, educate yourself. If you don't understand the basics of how precious metals markets work, how they're priced, what drives them, and what the risks are, you're operating at a disadvantage. There are excellent resources available, including Francis Hunt's own work where he goes deep into technical and fundamental analysis. Understanding concepts like support and resistance, trend lines, moving averages, volume analysis, and how to read momentum indicators will give you tools to evaluate market conditions for yourself, rather than just relying on what others tell you. Third, think about precious metals in the context of your overall financial plan. They shouldn't be something you speculate with using money you can't afford to lose. They should be part of a diversified strategy that includes other assets that aligns with your goals, your time horizon, and your risk tolerance. For some people, a small allocation to precious metals as insurance against currency devaluation or systemic risk makes sense. For others with higher risk tolerance and a longer time horizon, a more significant allocation might be appropriate. There's no one-size-fits-all answer. Fourth, stay flexible and open to changing your mind based on what the market tells you. If you buy silver expecting it to rally and instead it breaks down through support levels, don't stubbornly hold on hoping you're right. Cut your losses, reassess your thesis, and wait for a better setup. Similarly, if you're skeptical of precious metals, but they break out decisively, don't let your ego prevent you from recognizing that conditions might have changed and that maybe it is worth getting some exposure after all. Francis Hunt's ultimate message is one of preparation and awareness. We're living through extraordinary times economically and geopolitically. The decisions central banks make about interest rates and money supply, the trajectory of inflation, the strength or weakness of currencies, the state of geopolitical tensions, All of these factors are in flux right now, and they all have implications for precious metals. Silver, in particular, sits at a critical inflection point where the next major move could be dramatic in either direction. This isn't a time to be passive. This is a time to be informed, to be positioned appropriately based on your individual circumstances, and to be ready to act as conditions evolve. Thank you so much for watching this deep dive into Francis Hunt's Silver Price Alert. If you found this valuable and you want to see more content like this, make sure to smash that like button, subscribe to the channel if you haven't already, and hit the notification bell so you don't miss future updates, especially as we continue to track this critical situation in silver and gold markets. Drop a comment below letting me know whether you're positioned in precious metals right now and what your thoughts are on where we're headed from here. I read every comment and I love hearing your perspectives. Until next time, stay informed, stay disciplined, and happy investing.